I'm your host, John Light, founder and CEO of Sabretooth Recruiting. And today I got really lucky because I talked with my guest, Neha Banthia, some time ago, and we promised we'd get back together to record this podcast, and we kind of played volleyball back and forth until we made it happen. Neha, thanks so much for joining me today.
Thank you, John, for inviting me. It's my pleasure.
You know, it's really interesting because when we first connected and started chatting, you're sitting there as a chief risk officer at Encina Lender Finance. And I think part of what attracted me to the conversation is learning more because y'all kind of sprouted out of Encina Capital, which many people know about, especially in Silicon Valley and the tech world. So I'm hoping that maybe you can share some of the journey that got you to where you are and where you are with ELF and what's going on here to get started.
Yeah, sure. So about myself, I was born and brought up in India, came to the States in 2012. Typical, mostly Indian students, right? Like I was an engineering grad. My first job back in India was a software engineer job, but I am a very curious person. So I wanted to know why behind a lot of things. And being a developer or a junior developer, you're always told do this and not knowing why. And I just wanted to know why I'm doing these things. How can I understand the bigger picture and, like perhaps propose solutions that are not considered. And that led me into product management roles. So went into product management from engineering and moved to the States with my husband, joined Quicken Loans, which is now the Rocket Mortgage company.
Right.
So I joined Rocket Mortgage as a product manager on the servicing and collection side. That was in Michigan, had to move to California. So moved to California with my husband, joined Bank of the West, worked there in the data department as the data analyst, started and grew up there to be the leader in the data management group, supporting all lines of businesses, which is consumer banking, commercial, small, medium, and wealth management group. And I think that's the place where it really set the roadmap for next phase of my career. Being a data person in a banking ecosystem, you have access to entire financials. You can see how money is coming in, how treasury functions work, how risk management works, what lines of businesses are doing, and how money is actually deployed into the assets that banks have. I wanted to really take that learning into the next phase. I had great experience there into predictive analytics and prescriptive analytics. Went to Wharton, did my MBA from Wharton, and then decided to get into the business side, which is the next phase of why we are doing things. So that took me into the business P&L management role, joined Avant, and then back to Rocket Loans, where I ran the P&Ls, ran the personal loans businesses for both the companies, risk, pricing, underwriting, verification, all of those policies and strategies around those programs. And then that led me to Encina. So it's on the other side of the table where we provide financing, specialty finance companies where I used to work, and we provide liquidity to those companies. Our area that we focus on is small duration, granular asset classes, which can be statistically analyzed. And this is where my prior experience allow me to underwrite or look at the companies and asset classes that we are investing in and help us structure the deal that works for the companies where I used to be part of, the space that I used to be part of.
So you finance and lend to the lenders.
Correct.
In a sense. So let's talk about that for a second, because it's funny because in a way I feel like I'm testing out a theory of mine, that when you look at people over the course of a career and someone wants to hire X, whatever X is, they focus on what that person is now, but sometimes we miss the critical pathways and the experience gained on that critical pathway that leads you to be capable of stepping into something that a lot of people can't do. I mean, I know there's a lot of nuance and complication and compliance. And as a chief risk officer, I think you're sitting in a chair that is very forward looking for revenue typically. You sit in a finance chair like a CFO, it's like, what's revenue today? What can we do about it this month? But you tend to take, I'm sure, a more futuristic view. What's it going to be like 6 months from now, a year from now, 3 years from now? But in that context, Neha, neither here nor there to test my theory, right? But in the context of there at Encina Lender Finance, what's the biggest problem you solve for your clients? Because I think that's really helps us define what a company is and how it goes about it. So maybe you could spend a minute explaining that big problem and how y'all solve it.
Yeah, so the biggest problem, if you have to say, it's like you're solving liquidity problem for your client. Everyone needs cash. If I am an originator, I am in the lending business, I need money to run my business, to grow my business. Even if I have equity capital, that's not sustainable. You can't continuously originate assets and have liquidity available to you all the time. So you need some debt or asset-based financing, and this is the problem that we solve for our clients. But how are we different from all the investment management firms out there? Is number one, the team that we have structured is very different from a typical investment management firm. We have risk people in our team who are coming from the originator seat. So they have been in the lender role in their prior lives. They understand what problems lenders have. It's always your past, and you and I were talking about it before we started the recording, is like your past performance is not the indicator of your future results. And oftentimes when you speak with your lenders, they have done some mistakes, they have some past performance issues, and they need capital, they have some good growth plans, and they have a way to solve for that. Now we come from that place where we understand what policy changes, pricing changes, go-to-market changes that they are making in their business, and are they really going to change the trajectory of their business? If it is going to change, then can we give them some credit for that, which others are not willing to give in that space, and be a thought partner in that process with them? Because of our experience, we can be a partner, not just a lender. And that's our value prop. That's the biggest problem that we are solving. And I'll take an example. We had one client on our book. Their strategy changed materially. When they were in the deal, we were financing them, and because of that change in strategy, the available liquidity they had from us started to drop. You have eligibility criteria and concentrations limit in your credit facility, and because of that change in strategy, the more and more originations they were doing were becoming ineligible for financing. And as a result of it,
too much concentration.
Yeah, too much concentration, or eligibility was shifting in a different direction, or concentration was shifting in a different direction that we thought at the time of underwriting was going to be the case. So we worked with them completely as a partner, understood where their business is heading, and really helped them define what are the changes in the credit policy that would help them succeed in the long run, help them track the performance in the right way, help them actually keep their unit economics preserved, and then structured, or I'll say re-underwrote the deal, structured the deal where they were in the end happy with the financing, they were happy, they had more liquidity. And these are the examples that we take pride in sharing, because this is where we differentiate ourselves. This is the biggest advantage our clients have while working with us, is we are the partners. Our credit facility will evolve as their business evolves, and we will work with them to evolve their business, because if they grow, if they are doing well, we are doing well. It's not zero-sum game. It's all of us are thriving when our clients are thriving.
Okay, so you said something I want to glom onto for a second. You said we want to be a partner, not just a lender. And I like that, if I heard this correctly, when you hire someone, you love to hire people who have been in that chair as an originator, who have been on that side of the fence where your clients are today. I think that's smart, frankly. I mean, you got to have diversity of thought. I don't care where you're at, right? You got to be able to look at problems differently. But I'm afraid as we add technology to everything we do, that sometimes it's easy to lose sight over the empathy connection we develop as human beings. That, I've seen it going to talk about lines of credit for the business and this sort of thing. You go in and you end up feeling like, well, I'm a number. I don't fit precisely in a box, but I know I've got what's necessary here. It may not just look like the 8 people they looked at before, or 9 or whatever. And it'd be great to have somebody who can listen. It's even better to have somebody who listens and empathizes and goes, okay, we see what you're trying to do, and can say, here's how we can impact that. Here's how we can add value. Alternatively, maybe we're not the right solution, but here is another solution you could look at. I've always found it's not dissimilar to networking. When you build that empathetic relationship, people will do some things they'll do some things sometimes that aren't necessarily convenient to them, but they're doing it because of that connection to you, and it has value.
Yes.
And so I don't know, you ought to put that in a tagline somewhere. We're your partner. We're not just your lender. Something to that effect. Do I get like copyright fees or something for going ahead and trademarking that?
You know what? If you're putting on our website, we'll give you the credit.
I think you guys ought to run with that one. That's a good one. I don't know if that came out spontaneously or is something that you'd pre-planned, but that's a good expression. So let me ask you this. We're talking predominantly about asset-based lending. So my assumption is that your focus is going to be lenders who are originating financing for, let's just say, heavy equipment, industrial, maybe manufacturing equipment, maybe construction equipment, that sort of thing. Are there any other areas that maybe people aren't as aware of, and as far as the class of assets go, that you all support?
Yeah, so I'll actually take a moment to just explain what asset classes we are after. So our strategy is predominantly focused on short duration, granular size asset classes. When I say short duration, we're not after mortgages which are 30-year loans.
Right.
We are looking for something that's 5 to 7 year typical payback period. And when I say granular asset classes, the team that we have is very capable from a statistical analysis standpoint. So we want to invest in asset classes which are small ticket items that can be statistically analyzed, and we don't have huge concentration risk or concentration involved in our structure, right? If you are looking at, let's say, $75 million credit facility, and if you have 5 loans within that credit facility, each $20 million, or like each $15 million, you're taking a huge concentration risk. At that time, our underwriting would be to literally go and underwrite each of those 5 loans. We would go and underwrite each of those 5 loans and say, hey, you know what? Are we comfortable investing in this asset where each loan is underwritten by us? Now, we are after those asset classes where typical size or loan size is, let's say, $1,000, $5,000, $10,000, maximum $150,000. Now, in those cases, you have a very granular pool of assets. You can look at historical data. You can comfortably predict what the future could be. Or even if you don't have historical data, let's say we are working with clients who don't have a lot of history. They just launched their business. They are in the lending business. You can go and find some benchmarks from the industry. You can still see for a typical consumer segment, for a typical asset class, what historical performance have been, and can we have some underwriting or credit policy that our client is defining around that, where we can project what future performance would be and create a deal around it. So our moat is small ticket, small duration asset classes which we can statistically analyze and comfortably predict what the performance of that asset would be. Now, to answer your question, sorry, I diverted a little to just give a background. To answer your question, what are the asset classes that we are after? So consumer asset classes like credit card receivables, you have unsecured installment loans receivables, you have auto loans, you have small business loans, which are small ticket items. We have a portfolio of like service and repair loans. We are looking at some earned wage asset excess portfolios. So there are all these consumer small business loans out there. Interestingly, we have looked at debt consolidation or debt settlement
Okay.
programs because it's debt settlement. It's a future fee receivable that you would be financing on. It's not a loan or a cash of stream that's coming, a stream of cash that's coming from loan, but it's the future fee stream that we would be financing on. Music royalty businesses, like there are any sorts of asset classes that's
Yeah.
where you can analyze the performance and you can finance them, but primarily they are lending. Small business and consumer is where they fall.
I wish we had more time in the show to dive into this other topic related, because you're part of Encina Capital, which, people in the know are aware of them. You're in the Silicon Valley space and the tech space, but you're delivering something that's not necessarily considered tech. But I know you guys have to be levering AI, machine learning, whatnot, in order to manage your risk, to analyze it and understand it. I think we could probably have a whole nother show covering that. But I think a lot of people don't have visibility and understand what goes on behind the curtain or behind the door, and secondary markets and lenders supporting and financing lenders. In effect, there's an entire back room in industry, from an industry perspective. So my sense is we may have folks who listen into the show want to learn more. Neha, what's the best way for them to connect with you or with Encina Lender Finance, learn more and get up to speed?
Yeah, so they can directly reach out to me on LinkedIn. I am there. My first name is Neha, last name is Banthia. People can learn about Encina Lender Finance from our website. So it's called lenderfinance.encinacapital.com.
Okay.
So the information is there. We have a LinkedIn page where people can go and look us up. These are primarily, and like anyone in the company, people can just reach out to them and try to gather more information about us. But I'll say what we take pride in most is about our people, very strong pedigree, and they are very responsive. So, yeah.
Well, good, because they can always, if they're listening and you're connected with me, Neha and I are connected on LinkedIn, so she's easy to find. And if you want an introduction, well, just ping me. I'm more than happy to do it. And Neha and Banthia, thanks so much for joining me today.
Thank you, John, for having me here.